My name is Michael Grandi. I'm a CPA and I'm a professor at Providence College, and I'm currently teaching an MBA class at PC, and this is a graduate level managerial accounting class. And today's presentation is going to be a PowerPoint presentation on differential analysis. And we're really going to cover three topics. We're going to cover keep or drop what appears to be an unprofitable product line or division of a business. The second topic is whether the company should continue to make or buy a component of its product from another company. And thirdly, whether the company should accept or reject a special order. Only those three topics. There's a little bit more in that chapter, but essentially want to cover those three topics. So let me share the PowerPoint presentation with you. Pull it up on the screen here. And we'll start the slideshow from the beginning. And I want to be sure to duplicate the slideshow on both screens. So again, this is chapter 13 from the Garrison, Noreen, and Brewer textbook, 17th edition, differential analysis. So what's really important for you to be able to distinguish between is you need to identify relevant and irrelevant costs and benefits in a decision. Because quite honestly, there's a great deal of information that you come across. The question is, what is relevant with regard to making this business decision? So the key concepts are, the key concept number one, every decision involves choosing among at least two alternatives. Therefore, the first step in decision making is to define the alternatives being considered. Step number two, once you've defined the alternatives, you need to identify the criteria for choosing among them. Relevant costs and relevant benefits, often revenue, should be considered when making decisions. Irrelevant costs and irrelevant benefits should be ignored. Concept number three, the key to effective decision-making is differential analysis, focusing on the future costs and benefits that differ between the alternatives. Everything else is irrelevant and should be ignored. If it's the same under both scenarios, it can be ignored. We're looking only for the differences. A future cost that differs between any two alternatives is known as a differential cost. Future revenue that differs between any two alternatives is known as a differential revenue. An incremental cost is an increase in cost between the two alternatives, and an avoidable cost is a cost that can be eliminated by choosing one alternative over another. Concept number four, sunk costs are always irrelevant when choosing among alternatives. A sunk cost is a cost that has already been incurred and cannot be changed regardless of what a manager decides to do. And the classic example there is the company bought a machine 2 years ago that it's depreciating now. Well, they already spent the money on the machine, so that is an irrelevant cost. And secondly, the depreciation is irrelevant because depreciation is simply the allocation of that sunk cost over the useful life of the asset. Concept number five, future costs and benefits that do not differ between the two alternatives are irrelevant to the different decision-making process because there's no difference, there's no differential if they're the same under all alternatives. Concept number six, opportunity costs are also need to be considered when making cost decisions. An opportunity cost is the potential benefit that is given up when one alternative is selected over another. So here's an example of relevant versus irrelevant costs. Cynthia, a Boston student, is considering visiting a friend in New York. She can drive or take the train. By car, It is 230 miles to her friend's apartment. She is trying to decide which alternative is less expensive and has gathered the following information. The automobile costs are based on 10,000 miles driven per year. So the annual straight line depreciation on the car is $2,800, and you can see how they calculated that, or 20 cents a mile. Cost of gasoline, they've determined to be 10 cents a mile. And again, they show you how they calculated that. Annual cost of auto insurance and license, maintenance and repairs, parking fees at the school, and then she's come up with total average cost of 61.9 cents per mile. So there's a lot of information here. We got to figure out what's relevant and what's irrelevant. Some additional information on the bottom. We already figured out the 61.9 cents. Additional information, number 7, reduction in resale value of a car per mile. Round trip train fare, $104. Benefits of relaxing on a train trip, that's not a quantified information, that's a qualitative issue. Cost of putting dog in the kennel while gone. Benefit of having the car in New York. Hassle of parking in New York, well, we know what that's like. And the per day cost of parking a car in New York. Which costs and benefits are relevant to Cynthia's decision? The cost of the car is a sunk cost and is not relevant to the current decision. So therefore, the depreciation is also irrelevant. The annual cost of insurance is not relevant. It will remain the same as she drives or takes the train. However, the cost of gasoline is clearly relevant. If she decides to drive, if she takes the train, she would avoid the cost of the gasoline, so the cost differs between the two alternatives. Which costs and benefits are relevant to Cynthia's decision? The cost of maintenance and repairs is relevant. In the long run, these costs depend upon the miles driven. However, the monthly school parking fee is not relevant because it must be paid if Cynthia drives or takes the train. She has to pay it under both scenarios. At this point, we can see that some of the average cost of 61.9 cents per mile are relevant and others are not. The decline in resale value to additional miles is relevant because you're putting more miles on. The round trip train fare is clearly relevant. If she drives, the cost can be avoided. Relaxing on the train is relevant, even though it is difficult to assign a dollar value to the benefit. And the kennel cost is not relevant because Cynthia will incur the cost if she drives or takes the train. The cost of parking in New York is relevant because it can be avoided if she takes the train. The benefits of having a car in New York and the problems of finding a parking space are both relevant, but are difficult to assign a dollar value. From a financial standpoint, Cynthia would be better off taking the train to visit her friend. Some of the financial factors may influence her final decision. So here's the relevant information. Gasoline, the round trip, right? 460 miles, it's $2.30 each way, 10 cents a mile, $46. Maintenance, because you're obviously going to have to maintain that at a certain point in time. Reduction in resale. Again, the more you use the vehicle, the more it wears down. And parking in New York is relevant. So the cost of driving is $137. The cost of the ticket is $104. Clearly makes sense for her to take the train. Let's look at another example. Management of a company is considering a new labor-saving machine that rents for $3,000 per year. Data about the company's annual sales and costs with and without the new machine are as follows. So they're currently have sales of 5,000 units. The sale price is $40 per unit. And you can see they've got direct materials costs, direct labor costs, which if you look at it, the direct labor cost drops with the new machine. It drops by $15,000 because the machine is doing some work. The variable overhead stays the same. The fixed costs, other stays the same, but the rent of the machine, that's a fixed cost, $3,000 per year, goes up. So they're saving on labor by $15,000, but it's only costing them $3,000 for the new machine. So you can see net income increases by $12,000 because of the differential in costs. So in this case, it certainly makes sense to go ahead and buy that machine because of the reduction in labor costs. We can efficiently analyze the decision by looking at the different costs and revenues and arrive at the same decision. Again, just looking at the pieces that are different because everything else stays the same. The only things that changed were, one, the decrease in the direct labor and the increase in the fixed costs. Using the differential approach is desirable for two reasons. One, only rarely will enough information be available to prepare a detailed income statement for both alternatives. Mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that's really crucial. So we want to focus on our attention on what changes, the differences. Learning objective number 2. Prepare an analysis showing whether a product line or other business should be dropped. So this is a question of keep or drop an unprofitable product line or division. One of the most important decisions managers make is whether to add or drop a business segment. Ultimately, a decision to drop an old segment or add a new one is going to hinge primarily on its financial impact. To assess this impact, it's necessary to carefully analyze the costs. Due to the declining popularity, so there's an example here, due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years. Lovell is considering whether to keep or drop this product line. So here's how you want to make your decision. Lovell should drop the digital watch segment only if its profits would increase. Lovell will compare the contribution that would be lost if the digital watch line was discontinued to the fixed expenses that would be avoided if the line was discontinued. So I'd like to summarize that. So if the contribution margin given up is greater than the avoidable expenses, those would be fixed expenses, then you want to keep the division. However, if the contribution margin given up is less than the avoidable fixed costs, then you want to drop it. So here's an example. We have this the digital watch company. They've got $500,000 in sales. They've got $200,000 in total variable costs. Their contribution margin is $300,000. And you can see they've got $400,000 in fixed costs, net operating loss of $100,000. So the question is, if they eliminate the division, what goes away? Well, clearly the revenue goes away and clearly the variable costs go away. Because obviously if we don't sell the watches, we don't have the revenue. And based upon what you know about variable costs, you only have the variable cost if you make the product. If you don't make the product, you don't have a variable cost. So it's reasonable to look at contribution margin only. So we know very clearly that if they were to eliminate this division, all of the contribution margin would be eliminated. But which fixed costs would go away. The general rule is that fixed costs do not go away, they stay in the business. So you need some additional information. An investigation has revealed that the fixed general factory overhead and the fixed general administrative expenses will not be affected by dropping the digital watch line. The fixed factory overhead and general administrative expenses assigned to this product would be reallocated to the other product lines. So these two items don't go away, they simply get reallocated to the remaining product lines. So we know those items don't go away. And which ones are they? General factory for $60,000 and general administrative expenses for $30,000, for a total of $90,000. The equipment used to manufacture digital watches has no resale value or alternative use. And again, depreciation is always irrelevant. Should Lovell retain or drop the digital watch segment? So again, what goes away and what stays? So these are the contribution margin that is eliminated is $300,000, and these fixed costs can be avoided. They'll go away. The salary of the line manager, the direct advertising, and this rent on that space. That's what they're telling you. So you're giving up $300,000 of contribution margin, but you're only eliminating $260,000 of fixed costs. In this example, the contribution margin given up is greater than the avoidable fixed cost. Your conclusion should be to keep this division because the financial disadvantage of dropping the digital watches is $40,000. The Lovell solution can also be obtained by preparing comparative income statements showing results with and without the digital watch segment. This is much more time consuming. So you can see if you keep the digital watches, you've got that $100,000 loss. And then we want to see what's given up. So if the digital watch line is dropped, there's no contribution margin, right? So you can see the income statement, if you drop it, that's gone. On the other hand, the general factory overhead would be the same under both scenarios. The salary of the product line manager would disappear, so it's relevant to the decision. The depreciation is a sunk cost. Also, remember that the equipment has no resale value. So the equipment and depreciation expense associated are irrelevant to the decision. And lastly, the complete comparison, you've got the $30,000 of general administrative expense, which stays in the business. And you can see, again, the difference is $40,000. Disadvantage. Beware of fixed costs that are allocated because they can distort the keep or drop decision. Lovell's manager may ask, why should we keep the digital watch segment when it is showing a $100,000 loss? And you just explained it. The answer lies in the way we allocate common fixed cost to products. Including unavoidable common fixed costs make the product line appear to be unprofitable, when in fact dropping the product line would decrease the company's overall net operating income, which you just saw, because common costs, allocated costs don't go away. They simply get reallocated to the remaining divisions. Let's take a look at make or buy decisions. When a company is involved in more than one activity in the entire value chain, it is vertically integrated. A decision to carry out one of the activities in the value chain internally rather than buy externally from a supplier is called a make or buy decision. This is what vertical integration looks like. Smoother flow of parts and materials, better quality control, they realize profit. So what's happening if they produce all of the parts themselves. The key is better quality control. I would add further that not only do they control the quality, they control the delivery times. If somebody else is making it, they lose control over when the product gets delivered. Some disadvantages to vertical integration. Companies may fail to take advantage of suppliers who can create economies of scale advantage by pooling demand from numerous companies. While the economies of scale factor can be appealing, a company must be careful to retain control over activities that are essential to maintaining competitive position, specifically quality and on-time delivery. So here's an example. Essex Company manufactures part 4A that is used in one of its products. The unit product cost of this part is as follows. Direct materials, direct labor, variable overhead. I mean, those seem pretty clear, right? That they'll have those three costs if and only if they make it. Depreciation on special equipment, supervisor salary, general factory overhead. So this is what it costs for them to make it. The question is, if they buy it, which of these costs go away? Which costs would they not have to incur if they buy it from somebody else? Well, clearly the direct materials, clearly the direct labor, clearly the variable overhead. But what about the other three? The special equipment used to manufacture part 4A has no resale value. Therefore, it's irrelevant. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. So it doesn't go away. It's simply reallocated to other parts of the business. The $30 unit product cost is based on 20,000 parts produced each year. And an outside supplier is offered to provide the 20,000 parts at a cost of $25 per year. So they think it costs them $30 a unit to make it. They can buy it from somebody else for $25. So what should they do? Should they continue to make it or buy it from somebody else? So here's a make or buy analysis. So if they were to buy it from somebody else, it's $25 per unit. 20,000 units, $500,000. But what costs are relevant? What costs would go away if they were to buy it from somebody else? Clearly the direct materials, clearly the direct labor, clearly the variable overhead. The depreciation, so I need to pause this for a minute, I'm sorry. Okay, sorry about that, I needed to answer the door. So let me go back to the PowerPoint presentation that we were working on. Okay, so this was the make or buy decision, and the purchase price if they would buy it from somebody else was $25 per unit. They're buying 20,000 units, so it would cost them $500,000 to buy it from somebody else. But what are the relevant costs to make? In other words, what costs would go away if they were to buy it from somebody else? Clearly the direct materials, the direct labor, and the variable overhead. They would only incur those costs if they make it. If they don't make it, it goes away. The depreciation on the equipment is always irrelevant. It's always insignificant. So we can ignore it. The supervisor's salary is $40,000, and what they're admitting to us here, they didn't tell us, but what they're telling us here is that if they were to buy it from somebody else, they would not need that supervisor, and therefore it would go away if they buy it. So it makes it relevant. The allocated general factory overhead at $10 per unit is irrelevant because that cost would stay in the business. It would simply get reallocated to the other products. So in this example, it would cost $500,000 to buy it, but they would only get rid of $340,000. So in this example, it is cheaper to make it than it is to buy it. So they're going to go ahead and continue to make it. There was a savings of $160,000 by making it. However, what's an opportunity cost? Opportunity costs are not actual cash outlays and are not recorded in the formal accounts of an organization. An opportunity cost is the benefit that is foregone as a result of pursuing some course of action. For example, if the space to make Part 4A had an alternative use, the opportunity cost would have been equal to the segment margin, that's sales minus variable cost, that could have been derived from the best alternative use of the space. So what I'd like to say here is that if a company cannot take advantage of the opportunity, that means that if they continue to make the product, they're not able to take advantage of the opportunity. That is an opportunity lost, and a lost opportunity is the same thing as an opportunity cost, which needs to be added to the make side of the equation. And we'll see some problems that explain that a little bit further. So now we want to talk about special orders, whether a special order should be accepted or rejected. A special order is a one-time order that is not considered part of the company's normal ongoing business. When analyzing a special order, only the incremental costs and benefits are relevant. Since the existing fixed manufacturing overhead costs would not be affected by the order, they are not relevant. Again, we're only looking at, when we look at special orders, we're only looking at what comes in simply because they accept the special order, which would be the revenue from the special order and only the costs that are incurred if they accept the special order. Clearly, things like direct labor, direct materials, variable overhead, and maybe if they had to acquire a special tool to finish off that special order. So here's an example. Jet Inc. makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10 per unit, or half the price, right? This is a one-time order that would not affect the company's regular business. Annual capacity is 10,000 units, but Jet Inc. is currently producing and selling only 5,000 units. So they clearly have the capacity to do it. So this is where the company stands right now. This is without the special order. So as we said in the previous slide, they're currently selling 5,000 units at $20 a unit, got $100,000 of revenue. And you can see they have their variable costs, direct materials, direct labor, variable overhead, and variable marketing costs, which total $40,000 or $8 per unit, which is the $40,000 of total variable cost divided by the 5,000 units, $8 a unit. The fixed costs, as you know, by definition, are in this company, whether or not they produce any additional items. The definition of a fixed cost. Total cost stays the same as volume changes. So whether this company produces 5,000 units, 6,000 units, 7,000 units, 8,000 units, those fixed manufacturing overhead costs of 28 and 20 will stay the same. If Jet accepts the special order, the incremental revenue will exceed the incremental costs. In other words, net operating income will increase by $6,000. So again, what comes in and what goes out just because they accept the special order. They're going to have the incremental revenue. They're going to sell 3,000 units to this company at $10 a unit. They'll have incremental revenue of $30,000, but they'll have incremental costs, direct labor, direct materials, variable overhead, variable marketing costs at $8 per unit for those 3,000 units or $24,000. They have net incremental operating income of $6,000. So the key here is that, yes, they will accept the special order. Here's another example. Northern Optical ordinarily sells its Excellence for $50. The variable production cost is $10. The fixed production cost is $18. And the variable selling cost is $1. Customer has requested a special order for 10,000 units of Excellence to be imprinted with the customer's logo. This special order would not involve any selling costs, so they can avoid that variable piece, the variable selling cost of $1. But Northern Optical would have to purchase an imprinting machine for $50,000. So let's think about it. They're going to have revenue that comes in at some price. We don't know what that is yet. They will definitely have the variable production cost at $10 a unit. They will not have the dollar of variable selling costs, and the fixed production cost is irrelevant. We can ignore it because it's there whether or not they accept the special order. But the last item is they have to buy a special machine for $50,000 if and only if they accept the special order. What is the rock bottom minimum price below which Northern Optical should not go in its negotiations with the customer? In other words, below what price would Northern Optical actually be losing money on the sale? There is ample idle capacity to fulfill the order, and the imprinting machine has no further use after this order. What is the selling price per unit that they will accept? So we're just looking at the costs where they would break even, right? So the variable cost of production, $100,000. Where did we get that? It was $10 per unit for 10,000 units is $100,000. They have to purchase, let's go back and look at that, right? The variable production cost is $10 a unit, and they said the special order was for 10,000 units. So they'd have the total variable production, right? Quantity times price, 10,000 units, $10 a unit, $100,000. They need to buy that special machine, one-time use, only because they accept the special order for $50,000. So the relevant costs in this decision are $150,000. The number of units is 10,000. The cost would be $15 per unit. So at $15 a unit, they have a break even where they have zero net operating income. So that's, in essence, the rock bottom minimum price where they don't lose any money. So that's it. That's all we want to cover from this chapter. Really only want to cover, as I said, keep or drop, make or buy, accept or reject the special order. So thank you.